Welcome to the Finance Geeks, a podcast about real financial planning. Join us as we get into the nitty-gritty, discussing everything from pensions to portfolios. If you're into numbers, strategies, and running a successful practice, this is your ultimate geeky hangout.
Hello and welcome to Season 2, Episode 2 of the Finance Geeks podcast. Thanks for joining us. My name is Warren Shute. I'm here joined by
Paul Cleworth.
And today we're talking all things bulls and bears. So Paul, before we get tucked into bulls and bears, what have you been up to?
All been work this last few weeks since our episode 1, season 2. I'm surprised I have to put the hours in at the moment. Blasted Rachel Reeves and this up and coming budget. Because it's been so prevalent in the press about these speculative changes, I have had lots of discussions with clients, emails about, and we are taking action. Quite a few clients are taking tax-free cash from their pensions. Quite a lot of them are selling down some assets to use their CGT allowance and their marginal rates, their 10 or 20% bands. A little bit of tactical work going on about selling down to cash. So it's time-consuming. But one thing that I did do in the last couple of weeks, which you know about because you were there, is went to watch on the 22nd of October, Tune Out the Noise in London at the Soho Hotel. It was the new end of 2023. But it's the first showing of it, the Dimensional film, and I thought it was excellent. I really enjoyed it. It was professionally made by Errol Morris, and he's in his 70s, this award-winning director. He is, I think he's 73, 76, something like that. But I enjoyed it, and seeing lots of other revisers there. So, it's just been all work. Boring. What about you? What have you been up to?
A lot of work, don't get me wrong. I've been flat out with the capital gains tax. We haven't done any tax-free cash, but I did send an email to my clients with some historical snippets of Keir Starmer talking and stuff like that, saying we're not going to touch tax-free cash. So fingers crossed he sticks to his word. But lots of capital gains tax work, which is, to be fair, it's been good. I think this is where we add our value. I think as financial planners, we kind of coast along and then we do a lot of work. And we're there when it matters.
Yeah.
So if you're listening to this as a financial planner and you're getting a reoccurring income, that's okay, but you really earn your salt when the market goes south. And we're going to sort of talk a little bit about that later on. But also events like this, making sure you're doing the right thing for your clients, maximizing capital gains tax rates and anything else that they need to do. So Tune Out Noise, I really enjoyed that. I thought it was great. Had a great time. It's good to catch up with you and lots of other familiar faces and stuff like that, which was lovely. We had the CSI Financial Planning Conference, CISI Financial Planning Conference, which was great.
Oh yeah, how was that? Did you enjoy it?
I did.
I missed it, unfortunately.
I've been going now for 20 plus years, like that, and I really enjoy it. I like it. It's a good time to get together. I think sometimes, and this is a compliment, I guess, as well as a criticism, they put so much good stuff in, you actually want more gaps. You want more time after the presentations to ask the presenters more questions. Oliver Burke did a great session on Microsoft and things like that. And I wanted to ask more questions. We had to run off and go and see Nick Murray, who was speaking, which was another great one. But it's the chats as well, having a beer afterwards, catching up with people. But I guess the thing that I'm most proud of is I did a sub 29-minute 5K.
You did?
Those who know me, I'm not a runner. I'm not built like a runner. So that's not a bad time for an old guy, 50-year-old, who's got a man bod. No, dad bod. There you go. I hope I got a man bod.
I didn't want to say anything. That's great. Is that your PB? Is that PB?
No. A number of years ago, I did about 26 minutes, something like that. So I was on top form then, to be fair. But that's very a PB good. For a number of years, definitely.
Well done. That's
good. David Hearn posts lots of photos of him doing the 5Ks on Saturdays like that. So he kind of inspired me. I'm a bit competitive. Not with other people, but with myself. I love other people doing well, but I think, if you can do it, I can do it. So I got into that.
Excellent. I did legs with my trainer on Wednesday. We did some squat and some hex bar. He calls it hex bar squat. I call it hex bar deadlift. But we were doing all these exercises, and I really wanted to do legs, and now I can hardly sit down. My legs are hurting so much.
When you walk away and you've got sort of jelly in your legs.
Yeah. It's just if you go heavy, the recovery takes 2 or 3 days now. Being late 40s and all. Okay, should we get on with it? Our main focal point now.
Okay. Move over to the main focal point of today's show. Put my teeth back in when I say that. So, what are we going to talk about, Paul?
So this was we both talked about this as a good topic at the moment. I think it's going to work. We're talking about bulls and bears. So we're talking about markets, and bull markets when they go up and bear markets when they go down. So
How do you remember that? Do you just remember it, or
well, I think with the bear sleeping, I think it suggests that markets aren't going as well, and the bull. I mean, I always picture in my head the bull that's in New York on Wall Street, and I've had the picture, there. So the horns go up, so I sort of
that's
remember
it?
it that way. But
So
go on.
I remember it as the bull tossing you up with his horns, and the
Right.
bear sliping you down, pulling you down like this. But
Yes. Yeah.
after all these years, you kind of just know it. But when I was starting out, that's how I used to remember it: the bull tossing you up with his horns, and the bear swiping you down.
Very good, very good. So let's just clarify the definition of them in a second. But also the reason I wanted to cover these off, we've had a sort of sustained increase in prices over the last 12 months, and that is essentially the definition of a bull market, a sustained increase. Whereas a bear market is a sort of reduction in markets, a fall in markets by 20% or more. And because things have been going well, and there's so much happening in the world at the moment, I don't want people to get concerned or overly worried, but you just think, when's the next bear market going to be? So we put an email out at the end of September to our clients where we were sort of saying, and this is what to do, not if, but when the next bear market occurs.
Yeah, and I think that's really good language to use, and we use exactly the same language. When the market goes down, this is what happens. How are you going to feel? What's your emotional response? And it's not if the market goes down. I think we kind of labour that point with our clients.
Yeah. Well, it comes down to setting expectations. So for new clients, it's important that they understand what a reasonable rate of return is after costs and charges, that they understand what you would typically get long term, 10, 15 years plus. 15 years plus is long term, from 100% equity markets, and then what a reasonable rate of inflation is as well. So, I do talk about trying to manage clients' expectations in that regard. For existing clients, I've been telling them a lot of good news when markets have gone up. I've said, this is good, that we've had this sustained increase in the last 12 months. The last, I suppose, 16 years, ever since the end of the great financial crisis in '08, well, it was early '09, we've had a sustained increase in prices, and there's been blips along the way. But when clients have specifically seen high rises in their portfolios, I've been sending it to them and saying, look, things are going well. But at the same time, trying to manage their expectations moving forwards, and if need be, selling down some for cash, for making sure we've got enough cash. So it's all part of that discussion with clients on an ongoing basis about what's happening in markets. But
I
we
think
try not to focus on them. You can't
yeah,
focus too much on markets because you then shy away from what financial planning is and the things that you can control.
I think the key I'd say is I never take credit for doing well in the markets. So when my clients congratulate me and say, "Oh, thank you so much, the portfolio's done
Yeah,
really well," I say, it's not me, it's the markets. You're
yeah,
being rewarded for participating in the capital markets. This is what happens. And what goes up comes down, and
yeah.
I've got the ratios that we sort of talk about before. But
What range do you talk about in terms of a rate of return, and in your projections, and when you talk to clients about what to expect if you're, I don't know, 70/30 or 100% equities?
So most of our clients are probably, say, on average about 80% equity, and I think at 80% equity we project, I think, about 6%,
Yeah,
something like that. So we
net
give
of
it,
charges.
yeah,
Yeah,
6%
we're
return.
we're, we're the same. I mean, the data shows if you're 100% equities, the depends over what period you take it, but in some cases in the US, there's data that shows it's well into double digits. It's 10, 11,
Yeah.
12%. This kind of assumes that when you're looking at it, there's no costs or charges. There's a big difference, of course, between the market return and you look at one index. And this bothers me because some people, some individuals, some will look at, let's say, the S&P 500, and they'll see, oh, it's up 36% in the last 12 months. Why have I not got that rate of return?
Yeah.
And the answer is, well, you're not 100% in that index. We've got a diversified global spread of equities. You've got some Europe, you've got some UK, you've got some Japan.
In, in, a,
So
in a great way for a listener to sort of estimate the expected return is to take the equity allocation as a percentage and do that as a percentage of the, say, 9%. So if a client's 50-50, for example, they should be expecting around about a 4.5% annualized return, which is about half of the 9% roughly of what the
yeah,
market will do, 9-10%,
yeah.
something
Um,
like that.
there's been lots of discussions with myself, my staff, with other advisors recently about the very nature of investing and the very concept of risk and how to explain it to your client. So when I think about investing, I think 100% equities. And if I could have my way, I'd have three models, perhaps most. I'd have 70-30, 70% equities, 30% bonds, 80-20, and 100% equities. And say, look, if you're lower risk than any of that, and you don't want, insofar as you think that you want lots of bonds or other assets, just don't invest. Put it all in cash, because the very purpose of investing is to outperform cash and inflation. That's
Yeah.
what I say to my clients. And if you can project based on a realistic or pessimistic rate of return, let's say 6% in 100% equities net of charges, and it gets a bit more than that, which it can, then they're going to achieve their goals.
Yeah.
You've got to put these realistic assumptions in so that they can achieve them. So,
Yeah.
is that similar? What rate of inflation do you assume in your models?
3%.
Oh yeah, so we're very similar in that regard.
Rate 3% inflation, and I can agree completely with you on those three model portfolios: 100, 80, and 70. I think that covers 95% of our clients.
Yeah,
Anyone who is accumulating their assets has more than 5 years before they expect to access those assets, whether it's taking a lump sum or an income. We try to educate them on the benefits of being 100% equity.
yeah,
Now, most clients understand it, some don't, in which case we will willingly soften it down with bonds, but we'll just revisit it every year, make sure that they still appreciate what they're missing out on, because it's the loss of performance that they're giving up. When clients have taken an income, typically around 4-5% a year, that's when the 80 or 70% portfolios or
yeah,
75% portfolio kind of comes into play.
yeah. We did a bit of MI recently and looked at Transact, where most of the assets we manage are on. 99% of assets on there, and the average portfolio across all of them is 75-25. And
Okay.
I think partly that's because the average client age is 57, and when someone's got a bigger pot of money, let's say it's £1 million plus, that's quite a lot of money. They've got a big pot of money. These clients that are drawing, let's say 4% out of it because they're in decumulation, they don't necessarily want that level of volatility. And I do believe that historically bonds do dampen the volatility. I mean, the last 3 or 4 years during COVID, they've been pretty terrible, especially UK government bonds, as you know. And now they represent pretty decent value, I suppose you could argue. If we do get an interest rate drop in November and possibly December, theoretically the price of bonds would rise. But if you're 100% equities, I think you say to clients, what do you say in terms of potential for loss, or rather biggest peak to trough? What do you
Yeah.
say?
So we have a couple of sort of, I guess, sound bites that we say to clients to get them to really understand. We sort of say, typically for a 100% equity portfolio, you should be expecting around about 9% return a year on that sort of thing. But you can expect the portfolio to fall about 15% annually. And then at
Yeah.
extreme times, you should expect the portfolio to fall about 50%.
Wow.
So if you've got
That
any,
was it.
yeah, if you've got any listeners who have been in the game a little bit longer time, so back in 2000, 2007, and then the pandemic. All right, pandemic was a little bit less, about 30%. They're quite extreme times.
Yeah.
So
This is peak to trough, not in
yeah,
a calendar year. Yeah, because
yeah,
peak to
peak
trough,
trough.
that can happen, can't it? For
Yeah,
sure.
peak trough. And
And
then when we talk in a calendar year, we sort of say that the market's typically positive 3 years out of every 4. So 75% of the time you're going to get a positive return, and then one year in every 4 you're going to get a negative return. If we look at calendar years in the last 20, there's only been 4 negative years, and only one of those, 2008, was negative. Double digits.
double
So
digits.
the other 3 were single digits. So if you look at that as an investor,
Yeah.
I'm only going to look at my portfolio in December. I'm going to get my investor report through. I'm going to look at my portfolio in December. If you've only had 4 negative years in the last 20, and only one of those years is double digits, I think 2008 was about -8.
Yeah.
How risky is that? How volatile is that? It's really managing and educating and not being sucked into all this dogma about equities are risky, be more cautious, that kind of thing.
Yeah,
And so,
that's the biggest thing that I've worked hard at trying to explain to clients, that when I say the word stocks and shares, I then seem to say that means equities, and
yeah,
say both, and then remind them that in the models that we put together, which are low cost, evidence based, and we have index funds as well. So I say the dimensional funds we use are evidence based, and
yeah,
that the Vanguard funds are index based, which I think is
yeah,
pretty accurate. So low cost, 0.21% OCF, ongoing charges figure, as you know. And if we can control the cost, and we've got let's say 100% equities, our 100% equity portfolio has only got 5 funds, and it's 12,500 stocks. Now, if you've got 12,500 stocks, and virtually everybody's going to own Apple and Visa and Tesla and Microsoft and all of these, you've got you're diversifying and you're controlling all of these things. And that's not gambling, that's not speculating, that's proper investing.
Yeah.
Spreading your risk, diversifying, global market cap, and you know to try and explain to like that there's no comparison between that model of investing and trying to time the market, buy direct shares, pick and choose, using crypto or alternatives, or God forbid some other kind of asset.
Yeah.
Investing means equities 10 years, and the more that clients can just not look at their portfolio, if you like, the better. You
Yeah.
know, just
100%.
don't
Yeah.
look at it. It would be great if you don't do that.
Completely. Do you know, we mentioned tuning out the noise earlier, and I asked David Butler a question when we were at the conference, and I basically said, how does this all interact with behavioral finance? What's the sort of correlation? And I thought his answer was great. It's like, Dimensional do a great job at managing the money. So it could be Dimensional, Vanguard, whoever your choice of fund provider is, do a great job at managing the money. Our job really is to manage the client, manage their emotions, keep them in their seat for the long run. And that's, if I'm honest, a relatively easy job when you start in a bull market. But when you start at the crest of a bear market and the portfolio's down the first year,
Yeah.
that's when you earn your salt. That's when you sort of have to put your, money to your mouth and earn your stripes.
Yeah. Do you know, we've all had it, advisors that are listing, and yourself and I as well. You take on a client when just after markets have dropped, or rather just as they're dropping. So they've transferred their ISA, their pension, they put new money in, and the markets are falling. And it's hard work, but again, this is where, as you say, you come into your own, where you get you earn your salt. It's unfortunate if they're looking at it a lot and you've not set the expectations. It just reminds you the importance of explaining to them that this could happen at any time, but just ignore it and it'll go back up. And one of the things I like to say is that when markets are falling, the unit price of the OICs and unit trusts, the collective funds that we use, the unit price is falling, but you're not losing any units. And it's the same as your house. When house prices fall, and they do at various times, you're not losing any bricks in your house. It's
Yeah.
just the value of it is there's no big ticker tape over your house that says what the value is. Whereas now people can go on their phones, on the internet, they can look at their portfolio, they can see the values. But they've got to understand the importance of investing. So should we talk about why bear markets occur and what's actually happening in the world at the moment? Not to make any glorified predictions, but actually just to talk about what to look out for. Is that all right?
Yeah. Let's do it. Let's talk. Lead the way.
So when you get changes in, economies and markets are all dynamic, and when you get a change in consumer behavior, in trade relationships between countries, you get a slowing economy, you get poor economic data that comes out, and let's say that there's a recession when you have 2 quarters of negative growth. And when these things occur, and especially, I mean, when there is a lack of confidence in both the economy and the government, it can change so quickly, and all of a sudden, investor confidence falls, and markets just take a tumble. And we saw this in, I think it was September. There was the Japanese markets, because of various reasons, dropped about 12% in a day, and the US markets sort of dropped, and then within 2 or 3 days later, they were back up. But that was a sort of a blip, like Black Monday in 1987. But the thing that happened during the Great Financial Crisis, the GFC, was a bit more sustained. Of course, there was people sort of could see the reasons that this was happening because of Fannie Mae and Fannie Mac, and with problems with credit default swaps and all of this. It was all, the world was coming to an end because, of course, it was all unraveling, wasn't it? We were realizing that people were sold a lot of nonsense. And I think it probably lasted 18 months, 2 years before markets started to really creep back up. But that's the point. It's incredibly hard to predict, and we don't know when the next COVID-19 or SARS or geopolitical crisis is going to be. But what we do know is there's a big election happening in the States at the moment, and there's a big sort of a war going on in the Middle East, which seems to be getting worse, and that's going to have a knock-on effect.
It will. The sad thing about wars is stock markets tend to do better during times of conflict than they do of peace. I guess it's to do with the selling of arms and stuff like that, which is sad to realize, and we'd all prefer there not to be a war. But the worrying thing is, at the time of recording, the FT had Trump in the lead over Harris this morning. So, not
Wow,
that
because it was
this
the
is
other way
not,
around, wasn't it, recently?
but yeah, for quite a long time, yeah. And not that it's a political show, and you'll all have your own views and everything else, and we're not here to judge anyone for who they want to support and stuff. But yeah, I just think that will have a bigger impact on
Yeah.
the stock market if Trump does get into power.
Yeah,
But
yeah. The one of the things that I've sort of noticed, and what I don't want any listener to consider here is that I'm trying to predict markets or that there's going to be a bear market anytime soon, because we really don't know. But I think that stating the facts that we've had a good run, people should be pretty pleased if they've been invested in the last 12 months, last 10 years plus, and that it's about preparing yourself for what's going to occur. And we talk about then the US markets and what's going to happen if one candidate gets in over the other. But theoretically, it shouldn't make a difference. You'll know that in hindsight. I mean, do you remember when Trump got in the first time and he took a sort of credit for markets rising, and it was nothing to do with him. It's not none of the policies that he brought out. So it's be interesting to know when the next one is.
yeah, no, absolutely. It's I think stock markets generally rise over time. And the way we prepare our clients for potential bear markets things is just by saying to them, hey, look, any money that you're likely to need in the next 5 years, let's hold them into this short-term bond fund. We only use one bond fund. It's a global short-term bond fund. And we just make sure that clients have got any money they're likely to spend held in that. And we just remind them every year, just make sure they keep topping that fund up. So it's very similar to what you're saying, make sure we've got the cash buffer and stuff like that. So it's in place. So if they ever do need to pull on their pension or their investments, in theory, in maths, but not in emotion, it doesn't really matter what their portfolio is doing because they've got a security of that money of 5 years. Now, 5 years is a long time. And
Is that what you do? 5 years worth of short-term
5 years
bonds or cash?
Yeah, so we do 18 months of cash and 3.5 years of bond. Okay.
Oh,
And
right, okay.
the rationale between 18 months of cash is because we really want 1 year of cash, but because clients move their planning dates, they don't always come and see us on the anniversary of their previous meeting. We need a buffer there. So we have a buffer of 6 months. So that gives us a bit of leeway of when the client comes in for their renew their portfolio. And then we have another 3.5 years in short-term bonds.
So that's the bucket effect. That's what you do, the bucketing.
Yeah, and the reason we do it that way, the reason we have 5 years is I was a financial planner in 95, so I was a financial planner in 2000. And in 2000, we had 3 consecutive years of negative growth in the stock market. I'm looking at the figures here, quoting off the FTSE Global series, minus 4% in 2000, minus 14% in 2001, and minus 27% almost in 2002. So it started falling and it got worse as time went on. But of course, in 2003, it didn't recover the full loss. It took time to recover. So we had a 20% growth in 2003 and 8% in 2004. I want to make sure that my clients have got that security, that certainty of income should something like that happen again.
Yeah, well, this is why I've been intentionally contacting clients and about selling down and topping up for cash. If they're in decumulation, if they require additional cash and the cash pots that they have is less than 5 years, certainly if it's less than 2 or 3 years, now is as good a time as ever to sort of say, do you know what, we've had a good run over the last 12 months. I'll sell some money down for cash. If there's a gain, I'll pay some tax. That's a good thing. And I'll top it up. But as a rule of thumb, I like to say either have, say, 2 or 3 years of your expected income in cash. So if you've got £1 million portfolio and you're drawing 4%, 40 grand a year, half maybe is 120,000 in cash. That's one rule. Another is 10 to 15% of the invested amount that you have in cash at any one time. So it depends on a lot of things, their requirement for capital and what other forms of income they've got, whether it's DB schemes or state pensions or rental income. But Vanguard did a brilliant a white paper on this subject about decumulation during a market decline that you've just mentioned, about 3 consecutive years. And what people have got to be prepared to do is reduce the level of withdrawal not stop it completely, because usually we're holding 6 to 12 months in cash for that purpose anyway, so that's got to run out first. But they've got to be prepared to just tighten their belt, reduce the amount of income they draw out, and that over a long period of time extends how long the money will last quite
It does.
considerably.
We don't use it often enough, but the timeline software is pretty good at this, modeling portfolio drawdown, decumulation. And I forget what the term is called, but you can show it the standard 4% withdrawal indexing in line with inflation, but you can also show it where it doesn't index Geiger rules, I think, index during negative years. And that's the kind of principle we adapt with our clients. So, clients need more money, will revalue their income. They don't want it revalued every year. But if the portfolio's down, would suggest that they keep their level of income the same. So similar sort of thing.
Yeah.
Some clients are happy to forego and say, actually, no, I won't draw down on the portfolio this year. But when it's coming from bonds or cash, it's not affecting the equity portion. So just allow that to
completely. And this is where it becomes very tactical, if you like, and strategic, and where the advisor can add most of the value. I would say the planning there on the decumulation. Which pots do you take it from? How much? And if a client, let's say, is in their 60s and they've got health conditions and they're got less longevity, they say, "Oh, I don't think I'm going to live past 80." I mean, they don't know, but let's say that's the case, and they might be getting inheritance, or they might be downsizing in the future, so they want to take out more money now. Let's say it's 6 or 7%. A very difficult situation, a very difficult conversation to have. But the reality is, you can't just draw 6 or 7% from the portfolio with everything being the same, because of sequencing risk. And what that is as you know, is where if you have negative years in a portfolio, and the client's taking a high level of withdrawal out, especially if you have 2 or 3 negative years, it just doesn't grow back to where it was if you're taking too much, if it's considerably more than 4 or 4.5%. So you have to top up the cash. Maybe that's, as you say, it could be 5 years, could be more, if they're going to want to draw a lot from their portfolio. So, I've been doing a lot of that recently. Some of our clients that want to take more for 5 years, between 60 and 65, or 60 and 70, and then less after that. And we project those figures. So it's
So we describe the sequencing risk as reverse compounding. Same thing.
Yeah.
Just the compounding is working against you. And the way we manage that, when there's a bear market, the markets are going down, the equity market's falling down. We've got 5 years of income in relatively secure assets. We just won't replace it. We just won't replenish it. So we'll then have 4 years the following year. If the market was negative again, we just wouldn't replace it after 3 years. So we only really want to replace this bond cash portfolio when the bull market's here, when the market's going up.
It's not being afraid to take the profits, though. So if you've had a good time and a good return, if you've had a good return, you shouldn't be afraid of sort of selling some of that down for cash. And I noticed that some of the big wealth managers, some of the big banks, not naming any, but I've seen portfolio models where they treat all clients the same. So the client gives them, I don't know, let's say 100 grand, or with a big private bank, £1 million or £5 million, give them a big amount of money. And they'll have some in shares, some in alternatives, some in bonds, some in equities, some in funds, a bit of everything. And every client gets the same investment model. But there's no discussion of, utilizing the client's CGT allowance, topping up ISAs and pensions. I've noticed that they don't tailor it to the client's circumstances, or say, should we top up cash? Should we do this? There's just, with a lot of active portfolios, there's a lot of portfolio turnover and a lot of additional bells and whistles, which you don't need.
It's
digressing a bit there from bearables, but
it's an important point to note, because I think sometimes as financial planners we don't appreciate the good work that we do, and we just assume these bigger companies do great work because they're bigger, but often they don't. And there's no better accolade or confidence boost than a client telling you how great you are in the work that you've done. So really sort of makes
that's nice.
Yeah,
definitely. Do you I put a post out on LinkedIn fairly recently to say that, to question whether markets are overvalued. And it's when you watch the Tune Out the Noise film with Dimensional, and they say, look, all information is reflected in the price, and the price is a fair price. Markets are efficient, markets work. And I absolutely believe that. But at the same time, I wonder whether with the average US in the S&P 500, the average price to earnings ratio is about 35 to 1. and that's nearly double, and it pretty much is double what the long-term average is, the Shiller ratio or the Cape ratio. And Nvidia, one of the Magnificent Seven, is 67 to 1. And you think, 67 to 1, the price is 67 times its annual earnings. Isn't that a bit overpriced? Won't there be a correction? All of that worries me. And I think if people are concerned, they can either top up cash, they can put some more bonds in there. But let's talk about what people can do insofar as what they can control. If they think markets are going to be volatile, or there's going to be a bear market, or they're concerned, what do you talk to your clients about? What their options are?
Make sure they've got 5 years of their income needs in cash and bonds, and don't look at the stock market. Don't read the news. That's it.
Simple. Yeah.
It's really simple. Honestly, I'm not going to be getting clients to sell out because I think things are high, because every time you do that, it goes higher.
I know.
We experience all-time highs all the time. So yeah, we literally are that simple. It's a case of what money are you likely to need access to over the next 5 years. And this has been a great conversation about the capital gains tax planning we've been doing. It's digressed a little bit, but we've asked the question: what money are you likely to need? Well, I'm not going to touch your money, Warren. I don't need to touch. I've got this other money. But then why are we realizing capital gains? Why are we interrupting compounding?
Yeah.
So yeah, it's a little bit simplistic, and maybe listeners want a bit more detail. But that's literally what we do. Go on, tell me what we do.
No, discussing investing and equity markets, it is a complicated thing to discuss with clients, and I agree completely about keeping it simple. There are a lot of advisors and wealth management firms out there that demonstrate their value through complexity, through saying, I know something that the market doesn't, or we have this amazing investment system. And investing in itself is easy. Jack Bogle, the late Jack Bogle of Vanguard, would have said, buy a low, and Warren Buffett echoes this, buy a low-cost index fund, just leave it. That's it. So clients that are accumulating, whether, putting in lump sums and regular premiums over a long period of time, especially if they've got 15, 20 years before they need access to it, they just should put in as much as they can reasonably afford, and almost certainly be 100% equities. It's not advice, but it's a good suggestion. It becomes trickier when the clients, in their late 50s, 60s, they're decumulating, they want access to the money, and then you've got this discussion of, as you say, how much should you have in cash or bonds, and how much should we draw out of the models, and where should we draw it from, and which pots. And then it becomes a bit more tactical, and there's more ways in which you can demonstrate the value to the client. But Go on, sorry.
Go on, I can ask you what you tend to do.
So I focus on the things that we can control, like spread of risk, diversification, asset allocation. I talk about if markets are choppy, or you think they're going to be, because everyone's got an opinion on what they think the budget's going to happen, what's going to be in the budget, what's going to happen to markets, who's going to get into office in the States. You say you can suspend or reduce withdrawals if markets are choppy. If you are decumulating, you can focus on managing your own behavior. And as hard as it is, I tell you what's really hard, right? Not looking at your portfolio or your bank account for a week. Just try. It's almost as hard as going, I don't know, a whole day without looking at your phone. Your mobile phone.
You don't look at your portfolio in a week, though, surely?
No, not my own. I'm looking at clients' portfolios quite often, so they don't need to. Right. And you can see on Transact when clients log in. So you can see when some clients are logging in 3 or 4 times a day. It makes me think, right, I should probably have a call with them and say, there's not going to be any change. They're only priced once a day at the end of the day. It's only direct shares that change every day during the day. It's a constant battle to try and explain investing. But I tell you what's a really good sales aid to use, and I've got it here for those that are watching us on YouTube. This is the Vanguard Bulls and Bears Market. You can find this on the Tanner website in one of our articles in our blog. But basically, this shows all bull and bear markets since the World War II, since end of 1945, since the end of World War II, to the end of 2023. And Warren, guess how many years out of the 78 years they have been, that's right, since then, have been bull markets? Well, how many years?
I would say about 75 to 80% of the time. So how many years is it in total?
So it's 78 years in total, since 1945 to 2023. And
I'd say about 60 years.
Yeah, so it's 66 years and 9 months have been bull markets, so you bang on, and
More.
11 years and 4 months have been bear markets.
Because
So
the market's up 75% of the time,
yeah, exactly. Or,
3 out of every
according to
4.
this, a bit more. It's like
Yeah,
nearly 80 or
more than that.
85%, which
Yeah.
is quite astounding. And
When
so,
I
go on.
first came across that statistic, it shocked me. It did surprise me because we're always drummed into us how risky the stock market is and stuff like that, and it really did shock me. But it's a powerful statistic. If you really realize, the best thing you can do as a listener is do the calendar annualized return for the index that you want to use. We use the FTSE Global Index Series because it covers like 95% of the world tradable market. But whatever it is you want to choose, don't choose something like the S&P 500. It's too niche.
Yeah, exactly.
And just look how many negative returns there are, how many negative years.
And as soon as you get it into your mind that investing means 10 years plus, that investing means 100% equities, arguably, or certainly 70, 80%, and, pay yourself first, save, contribute to ISAs and pensions, if people just followed this advice, they would be laughing. I mean, there's still a lot of skepticism about pensions. Oh, pensions are terrible because, well, what people read and their experiences, and equities, no, that's risky, isn't it?
Yeah.
So isn't it crazy how on a risk scale you have to show low risk being 100% bonds and high risk being 100% equities? And actually, over a long period of time, it's exactly the opposite. It's exactly the opposite. If you invest in 100% bonds over a long period of time, 20 years, you will be worse off, guaranteed, compared to 100% equities.
Yeah, no, 100%. Yeah, definitely, 100%. It's I think the key really for the listeners is to have a researched, proven, repeatable process that you can roll out, so you know that all your clients are getting the same, not the same funds, but the same advice. Does that make sense? So you have a strategy, a structure, which is evidence based. You say, okay, I've looked into it. This is my approach, rather than sort of picking up doing something different for each individual client.
Your USP as a firm, in my opinion, should not be your investment methodology. I mean, insofar as you're not demonstrating the value through your selection of those funds, you're not. There's a little bit because we can use platforms like Transit that the client can't. We can use funds like Dimensional that the client can't. We can get access to institutional funds. But the point is, I would absolutely argue that the majority of the value is in the financial planning, is in the strategy, is in the service, and is in the way that you build trust with your clients. And when my client phones and the phone is picked up virtually immediately within 3 rings, I think there's a lot to be said for that. Because if you phone a big company, you try and get through to the same person or to any department within 10, 20 minutes, you'd be struggling.
Yeah, no, absolutely, 100%. So, anything else you want to talk about on the bulls and bears?
I have got some bulls and bears quotes.
Okay, so
of course we have. One of these days we'll do some anecdotes, but some short stories, some interesting ones. But let's stick with a couple of quotes. Have you got a quote about bull and bear markets?
My quote is from Sir John Templeton, and he said, "Bull markets are born on pessimism. Can't even say it. Grow on skepticism, mature on optimism, and die on euphoria."
Very good. I wonder if he said that just off the bat or whether he really thought about that.
He was a pretty bright guy. He was pretty bright.
Yeah, he was a renowned investor, philanthropist, and pioneer of investing, and he died in 2008.
He did. Yeah.
I looked it up. So I've got a couple. One of my favorite quotes, honestly, God, about investing is from Warren Buffett. One of the richest, smartest men in the world, and he just said, as you well know, this quote: "Be fearful when others are greedy, and greedy when others are fearful." And I always like that one. Benjamin Graham, author, passed away now, economist. He basically said, "Bull markets make you money, bear markets make you rich." It's interesting because the optimal time to invest is when markets are low. Now we don't know when that's going to be, but if and when there is another bear market and you see that markets fall more than 20%, if you're really smart and you follow both Benjamin Graham and Warren Buffett's advice, you would pile into the market. You'd be buying at a lower point.
Ben Graham was Warren Buffett's teacher at Chicago University.
There you go.
Teacher. And he died broke.
Did he? Well, he should have got a decent advisor like yourself, Warren, shouldn't he? Eh?
But it just it's an emotion game. It's a motion game. Going back to David Butler at Dimensional saying, we manage the money, you manage the emotion, you manage the individual.
Yeah.
And this is why I think DIY investing doesn't work for most people, because it's all well and good while the sun's shining, the markets are going up. But when things get a bit rocky, that's when we earn our bacon. This is when we have better good value. And having that conversation with clients saying, okay, we're going to invest £1 million. Do we go straight into the market or do we phase it in? Where do we sit on that? Just having those conversations with clients is really important. So
Yeah. I definitely do a lot of phase buying and pound cost average money's in, usually over 3 or 4 periods. I think that's sort of the optimal time period. But no, I think it was good. We talked a bit about bulls and bears there. Hopefully, those listening might have got a few nuggets from that, perhaps.
It's we've had a few good comments as well on social media and things. So listening to this, you think, do you know what? I want to get Warren and Paul's opinion on something. Please just message us through and say, look, put it forward. We'll have it as a topic for a future show. We've got some things coming forward. And that's it for a wrap. Thanks for tuning in to the Finance Geeks.
Thanks, guys. See you next time. Bye.
Bye.
Thanks for tuning in to the Finance Geeks. Don't forget to like, subscribe, and drop your comments on YouTube. Got questions? Send them our way. Follow us on social media and join us next time for more insights to boost your financial planning game.